your lips to God's ears. I hope that the inflation does peak this year and does come down because people are hurting.
We're living in the most unprecedented time of my entire investing career. Outside of the March 2020 crash, I've never lived through a period of interest-raising environments along with a hyper-inflated market. And what we're going to do is hear from Jerome Powell, who recently just spoke in front of Congress, talking about how he currently sees the economic circumstance. But first, we're going to take a look at the Canadian economy that just raised rates, what that's doing for the Canadian markets, and generally just what could happen moving forward. And if this is a conversation you appreciate, help the channel out, folks. Hit that button, and then we're going to listen to Jerome Powell actually speak in front of Congress. But first and foremost, guys, the Bank of Canada raised its benchmark interest rate to 0.5% on Wednesday, a move that is expected to be the first of a series of small rate hikes this year in an attempt to tame inflation. It's the first time the bank has raised rates since 2018, and the Bank of Canada rate affects the rate that Canadian consumers get things like mortgages, line of credits, and saving accounts at their own banks. Now, while the bank has been telegraphing its plan to raise its rate to fight inflation for a while now, the bank acknowledges in an announcement on Wednesday that inflation is heating up faster than anticipated because currently the Canadian economy grew at a 6.7% annual pace of inflation, which right now I would argue is much, much higher than that. But what does this mean for your investment account? Banks, as I mentioned at the beginning of this year, the bank trade has been the trend that is your best friend. Outside of large dividend yields, guys, the Bank of Nova Scotia on this news is up 2.76% in the middle of trading day today. Canadian Imperial Bank up 2.73% RY, Royal Bank up 1.18%, TD 2.54%, and that is leading the entire Canadian TSX S&P composite to be trading up 0.02%, finally green on the year, outpacing the U.S. economy. Now, I'm very curious because these are very tiny interest rate hikes. They're not aggressive, and something tells me they're going to need to be way more aggressive, and I think we could see a teetering effect where that starts hindering the global market here, but God only knows, time will tell. Now, talking about the inflation rate, guys, the only comparable time period to what we're living in right now was the 1980s. The U.S. economy is seeing a 7% inflation rate, and because of the crazy spike in crude oil recently, that is only going to push the current housing crisis, the extreme rallying in housing and other materials, to only go higher. Food, all that stuff, right? And inflation is taken based off what it costs the average person to live, including rent, food, travel, all that fun stuff. So taking a look, guys, the inflation rate here is literally as high as it's been in about 30 or 40 years, going back to that 1980 crisis where oil also went through some pretty high spikes. But what I find is oil is an interesting indicator that isn't 100% accurate, but through the last few recessions, oil has usually spiked up pretty dramatically. I mean, in the 2008 financial crisis, here we don't have a chart that goes far enough to see how the 1980s were fully affected, but there was a lot of volatility in oil back then as well. And it's going to be neat to see how all this comes into play. So let's talk about how Jerome Powell is currently seeing this market and exactly what's going on with them at Congress.
Compounding these fiscal policy mistakes, the Fed pursued for too long an unconventional and overly accommodated monetary policy, which has resulted in an inflation crisis that is hitting our constituents where it hurts. It is clear the Fed is not satisfying its price stability mandate. I look forward to hearing from you on the path forward to address the monetary policy side of this equation.
Inflation increased sharply last year and is now running well above our longer-run objective of 2%. Demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus, and price increases are now spreading to a broader range of goods and services. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. We continue to expect inflation to decline over the course of the year as supply constraints ease and demand moderates because of the waning effects of fiscal support and the removal of monetary policy accommodation. But we are attentive to the risks of potential further upward pressure on inflation expectations and inflation itself from a number of factors. We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market. Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month. The process of removing policy accommodation in current circumstances will involve both increases in the target range of the federal funds rate and reduction in the size of the Fed's balance sheet. Reducing our balance sheet will commence after the process of raising interest rates has begun and will proceed in a predictable manner, primarily through adjustments to reinvestments. The near-term effects on the U.S. economy of the invasion of Ukraine, the ongoing war with sanctions, and of events yet to come remain highly uncertain. Making appropriate monetary policy in this environment requires a recognition that the economy evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook.
So in summary, from the U.S. side of the border here, guys, Jerome Powell basically thinks that after the supply constraints kind of work themselves out, that we should see a cooling off in the inflation rate. The problem is we are nowhere near close to cooling off. We are still accelerating thanks to the geopolitical factors affecting fuel, the fact that the supply constraints continue to persist, and the housing market and everything else is still widely out of control. In that Congress hearing, the Congress lady basically said that Congress will have to step in if they're going to help on the inflation, whether that is making better regulations for housing development or just generally doing everything they can to get control of like fuel supplies and all this other stuff. So my best guess here is coming up on that meeting, which I think is March 15th. So in 2 weeks, that is when we'll see the first material interest rate hike, which will do probably what the Canadian Treasury did, which is just a tiny basis point just to see how the economy feels. And then as we head through the next few quarters, if inflation doesn't slow down, which I'm arguing I don't think it's going to slow down, they're going to get way more aggressive because Jerome Powell makes this soothing, nice chat about how they think things are going to cool down. Things aren't going to get too crazy. But if it does, he said they will use the tools they have to get inflation under control. If we head into that time period, it'll be exactly reminiscent of the 1980s. The interest rates are going to spike aggressively. And I don't know what material that is going to do to the markets because obviously nobody really knows because even in a recession time, sometimes the stock market does very well. But my anticipation of a recession right now is at least 70 to 80% because as spending becomes more and more costly, it lowers what the general GDP is, the gross domestic product sales of how people are buying and trading goods. Obviously, people are going to take a cooling off period to probably save more money and obviously drive less and do everything they can to not see their spending go drastically through the ceiling, which it already has. So these compounding effects of all these different macroeconomic circumstances are going to lead into something, like I said, that is so unprecedented in my time. I can only go back to the very beginning statement from Congress that I showed you, which is from, your mouth to God's ears. I hope inflation doesn't get out of control. But I pass the question off to you. What do you guys think about this in that comment section below? I'd love to hear about it. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.